If your stop loss sits just below the obvious swing low, the algorithm knows. So does every other trader's stop. That cluster of stops becomes a liquidity pool, and the market routinely sweeps it before reversing in your original direction. Today, why stops cluster at predictable prices, the liquidity sweep that takes them out, and the simple ATR buffer that places your stop where the algorithm isn't fishing for it. Here's the structural problem. The textbook says place your stop just below the most recent swing low. Every trader reading the same textbook places their stop in the same place. That cluster of stop orders sits there as a pool of pending sell orders, pure liquidity. The market or the algorithm running it has an incentive to spike down through that level, trigger every stop, and then reverse. From the institutional side, you've just sold them shares at a discount. Watch this in a synthetic chart. Swing low at 105, textbook stop at 103. The market dips down to 102 on a single bar, sweeps all the stops, and then reverses immediately back to the upside. You're stopped out at the bottom tick. The trade that would have worked is no longer your trade. That's not bad luck. That's the structure. Predictable stops are vulnerable stops. Here's the fix in one rule. Instead of placing your stop 1 cent below the swing low, place it 180 or below the swing low. That's the 14-period average true range. That extra buffer puts your stop outside the obvious cluster. In territory, the algorithm doesn't have an obvious incentive to sweep. The cost is a wider stop, which means a smaller position. The benefit is dramatically fewer stop outs on noise, and the math overwhelmingly favors the wider stop. Now with the ATR buffer. Same trade, same swing low at 105, but stop now at 100, a full ATR below. When the sweep comes through to 102, your stop is below the bottom of the sweep. You stay in the trade, the reversal happens, and you capture the upside the textbook trader missed. The wider stop forced a smaller position size, but the survival rate of the trade went up dramatically. That's the real win. On a real volatile chart, scroll through any liquid stock and look at the spike low candles. Most liquidity sweeps spike less than 180 or below the level before reversing. That single fact tells you ATR is the right buffer, wider than the sweep, tighter than necessary. Use it consistently and you stop being food for the algorithm. You become the trader the algorithm has to fight for, not the trader it routinely picks off. So stops cluster at obvious lows because everyone reads the same textbook. The algorithm routinely sweeps those clusters. Place your stop 180 or deeper than the obvious zone, size your position smaller to compensate, and the same trade survives more often. The math favors the wider stop. Subscribe for the full method and trade your own plan. Education, not financial advice.